It's Fed Day, and there's some small tweaks to the messaging and some other ones that are very important. Let's dive into the data, the words, and more with Mr. Ben Breitholtz, data scientist at Arbor Data Science. Ben, welcome back to the show. You brought us some good charts as always. Let me just kind of get your first kind of top-down takeaway here from what we heard from Powell today. What's the elevator speech on what your big conclusions were?
Yeah, so I think Powell showed that you can have optimism with him raising the expectation for growth in 2021 to 6.5%, but still be dovish, and that's not going to cause major problems for financial markets. The big thing here to really look at going forward is kind of two things. One, what is the Fed going to do in the face of potentially rising inflation above those targets they have or expectations of 2.1, 2.2%? Are they going to be willing to sit on their hands and essentially allow inflation to run hotter than normal, and maybe even allow the curve to continue to steepen and not say or do anything? And I think we saw a little bit of some cracks with that, with 7 of 18 participants showing that there could be a hike in 2023, and we can get into some of the words of agreement that's actually fallen off as well. But the second thing too is now the inflation story becomes, I think, front and center. The Fed is going to maybe be able to keep a lid on real yields and really anchor the short end of the curve. But now this is an inflation story, and that maybe was all this talk and narrative, but it really didn't matter so much until now, because now we're finally starting to price in a right side tail for headline CPI beyond just the base effects, and that's something that's really only happened in the past couple of weeks, which I think is going to be a game changer.
Ben, the agreement about rates, you mentioned a tick up in a few voting members that are thinking about 2023 as a hike, right? The communication is something you actually track, so let's start there. You say that the words of agreement are on the decline. Is that just because of a little disagreement there on what might happen in late 2023?
Yes, I think so. So we saw agreement really rise. So again, what we're doing is we're taking all their speeches, statements, pressers, and looking for how often are they giving each other high fives and agreeing. And what we saw was to the build up to kind of forming the AIT framework, there was a high degree of agreement, kind of like we saw in the earlier days ahead of the announcements of different QE packages. But over the past maybe 2 months, this has actually precipitously dropped, indicating that maybe, it's not saying that they're in disagreement, but it's saying that there's some fractures occurring somewhere and maybe not the same level of agreement. Now, why that's important is that typically there's a few things that kind of move real yields as of late. It's the amount of agreement from the Fed, their overall sentiment, which are still kind of talking somewhat downbeat historically about the economy, now looking for better days in the future. And then also their a level of ambiguity, which has been really low, meaning Powell's been crystal clear. If we get any of these to appreciably move, real yields could shoot higher. Agreement is one space that's starting to do that, but I think the clearness of Powell's communications will help keep a lid on those real yields. And now it's up to inflation expectations and really markets beginning to believe inflation is going to run hot and then kind of push it to the Fed a bit.
So here's what's so interesting, Ben, is breaking down, trying to sleuth through all the different complex inputs for what drives rates higher, right? And right now, there seems to be kind of a notion, at least in the response today, the way long bonds rallied. Obviously, it was a big rally on the shorter end. We saw much more powerful drop in yields, even the 5-year kind of in the middle as opposed to the 10-year, which got a rally as well. But we kind of just ended unch from where we were. We rallied way back from the intraday. So the question for a lot of investors who use that 10-year and kind of that longer end as their benchmark, what do we know about what drives that to see if today's actions and the confirmation is going to slow its ascent, if it's going to accelerate it, if it's going to reverse it? What do you think?
So I think this is kind of easy. What we can do is let's just look at 10-year nominal yields, which are maybe just a little bit above 160 basis points. And how have they been correlated to their two different components, real yields and then the tips break even, which essentially is the inflation expectation. And since the early portion of February, it was all real yields. So the correlation reconnected nominal to real yields. That shot back up to 0.8 over the past 2 months. Its connection to the tips break even plummeted. So really the big burst we saw from 110 to 160 in 10-year note yields had to do with real yields, term premium, and really, people fearing hikes coming into 2023, maybe 2022. That's going to go away. So that means that there could be somewhat of a hurdle and could compress yields to a certain extent, and that kind of now leaves the door open for inflation. Does inflation start to actually print higher than expectations? If you look at core goods, core services, core goods is down around 0% on a 3-month annualized basis. You have core services around 1%. It hasn't shown up yet. So what we want to see is higher than average prints, and then we need to see markets again price in that right side tail. And if you look at inflation swap caps and floors, another way of looking at inflation expectations, they just over the past week priced in a better than 50% chance of 2.5% headline CPI over the next 2 to 5 years, which to me is finally inflation expectations mattering. And the more that we can price in a tail, the more that will reconnect to nominal yields from this low correlation. And you have a good chart up here too. I think this is something key to watch is when investors should be concerned over the near term about these rate hikes and inflation will be represented and shown in really in hedging activity at the short end of the curve. And we can use something called swaptions. Don't worry, it sounds complicated, but just think of it as implied volatility. In this case, on the 2-year maturity, and we're looking over the next 1 through 5 years. And if you look at the next 1 to 2 years, those volatility expectations are still at pre-pandemic levels or below. And this is kind of emblematic of the financial conditions that Powell's afraid of. I think that as long as those remain dampened, Powell can look at them and say, okay, the markets maybe don't fully get the picture, but they're not freaking out, so to speak. But if we can get those to pop higher and above pre-pandemic levels, now the inertia behind that yield rise is going to even get stronger, and I think again that's going to have to be predicated on inflation and this 2.5+% headline CPI getting priced in, because you need that. It typically runs 30 to 50 basis points hotter than core inflation.
So okay, there's a lot in there, Ben, but what it seems is right now the potential for volatility in the bond market via inflation is one that can keep the long yields moving higher as the data actually manifests itself, but not at a rate that we have any reason to think Powell will be threatened just yet. Now, to be clear here, it seems like what we're learning is that there's going to be a big difference right between the short and the long end. We should generally expect, if you have the baseline assumption that growth is going to continue and that some inflation will arise, then the 10-year and the long end of the market will continue to go upwards, even if Powell says no hikes, right? So even if he says, look, I'm not going to have to hike because of this, should we think that the long bond can still rise in yield?
Yeah, I think what we could see really is the curve continue to go steeper and steeper, kind of going above expectations. If you look back historically at global recoveries, we're kind of at the point that typically the 3-month yield starts to rise. The curve would maybe start to think about flattening in the event that the Fed would get hawkish and raise rates. That's not going to happen this time around. So we're going to have a couple of years here where things can run hot, and that means that the long end of the curve is likely going to have to price higher. If you look at risk assets, where do risk assets say the 10-year note yield should reside? It's around that 2% mark right now. And so maybe that's kind of the pain point, or maybe even a target of where we need to go. In the interim, yes, Treasury yields, with the idea that real yields can be capped and this fear of rate hikes is kind of diminished. It could lead to some grinding here over the weeks to come. But bigger picture, we're looking for higher yields, just not rip-roaring yields. And the last time we spoke, we talked about really the best friend of a bond bear here is this low vol, slow rise in yields. And as long as inflation doesn't print really hot and the Fed can keep control and wherewithal to not hike, I think that that's something we could see at the long end of the curve. And we'll continue to see some oddities, kind of like we've seen with the TIPS break-even curve inverting. That's a sign that AIT is actually working. I know some say, oh, that's not, we don't want to see short end inflation expectations that run that hot relative to the long end. But to me, that's the AIT working the way that it should.
So the move in yields has already been faster than average compared to most recoveries. from the chart that you've got here that I see. Obviously, the break-evens are moving pretty quickly relative to recovery since 1960. The 10-year itself is also up there. It looks like third only to 1983, 1998 as well. There's the 10-year tips that are picking up pretty quickly. And then the 10-year note, we'll look at that chart in a sec, which is a little bit kind of harder to discern, but you can see if you squint a blue line that basically shows we're moving at a fairly quick clip by historical standards. Now, Ben, here's the thing in terms of thinking about the target for where it could go is if we know that Powell is now pricing in 2.4% inflation, and we know that he's not going to hike when we get there, which means we could stay there for a little bit, then why does the bond slowly climb in yield? Why not just go straight basically to a price that is equal to what an investor would be able to get in inflation? Do we still have a gap that, how big of a gap should we think there is between longer bond yields and actual inflation?
So this is the conundrum. I think that what the Fed now is a show me, results-based kind of idea or a kind of thought process. They want to see that realized inflation kick higher. And I think investors are kind of doing the same thing, even though they're starting to price in that right side tail. They want to see the realized inflation prints before they let things run really wild in terms of selling off and maybe shedding treasuries and demanding really higher term premiums and a higher yield. So, but what I've kind of been thinking a lot about lately is really with the Fed willing to sit pat and let the economy finally run hot. This is something we really haven't seen since 1995, where the markets will be really potentially seeing an appreciable rise and really kind of a staying rise in core inflation. That's something we would see prior to 1995. You get a global recovery, and you would see a core sticky inflation rise and stay there for at least a period of time. And that in the charts we were showing, tips break-evens, for example, which we simulate back to 1960, under those scenarios, would go on to add another 60 to 100 basis points from where we are right now. And that's something we just haven't been accustomed to. In terms of the actual treasury yields, that's something we could see to the order of 80 to 100 basis points, which would take us to somewhere around 260. So if we go back to this framework that kind of existed pre-1995, I'm not saying that's exactly going to happen, but I think this is what's kind of getting into the minds of investors, letting things run hot. We can't look at the playbook maybe from 1995 to current. Maybe we do need to look further back. I'm not saying 70s, but let's look at 80s, 90s. And that paints a picture where yields really could finally rise appreciably. Again, I wouldn't be shocked in a year's time to see the 10-year note yield reach that 260 point if we kind of stay on the same trajectory. I just don't think it's going to be getting there, like you were saying, overnight.
Sure.
I think there's too many things at play here.
Well, you're still basically looking at a target that would be handsomely above where the average estimates are right now from Wall Street. If you say that kind of the historical precedent for this type of environment could get us to 2.6 a year after, basically a recovery. I'm looking at your chart right now, 365 days. Then that's kind of like a mid-twos by year end, it seems.
Yes, I think that's possible. And, for everyone in the risk side of things here, that sounds scary potentially. But again, it depends on how much of this is also occurring along with real yields. So real yields and this swaption or the volatility that exists in the treasury market, that's what's going to be critical for risk asset investors. So if you really want to track this, a great way is just pull up the VIX and look at a correlation, rolling correlation to tips break-evens. And you'll see there, once that starts to go back to positive territory, which it really hasn't been since Volmageddon, that's going to be a good clue to you that, okay, I need to be concerned about this inflation story. Yes, we've seen 10-year note futures become positively correlated with S&P 500 E-minis. I think there was a sniff again of this rate hike getting pulled in closer and closer. I expect that to somewhat fade going forward. But there's some key measures to watch. Swaption vol, and I think this correlation with the VIX and tips break even.
All right, I like that. Ben, pleasure as always. Thanks for coming on.
Thank you.
Ben Breitholtz joining us from Arbor Data.